Well, artificial intelligence has been compared to everything from the internet boom to the dot-com bubble, but our next guest says a better comparison might be electricity. For more, we're bringing Erik Hirsch, co-CEO of Hamilton Lane. Erik, it's good to see you. Maybe let's just start right there, Erik. You compare AI here to electricity, not the dot-com bubble. Start there, Erik. Explain that comparison to me.
Yeah, Josh, great to be back with you. I think the dot-com era was a huge advent of change, but to say that it impacted every single business is simply not true. It also disrupted jobs, but in many cases just caused that position to move from one kind of retail store to a different kind of Amazon-oriented building, but that wasn't wiping out jobs. I think the advent of electricity is a much better analogy where that sort of ushered in the second industrial revolution, and it truly changed everything. It changed how society operated. It changed where societies were located. It changed supply chains. It changed how cities were built. And it brought with it the advent of all kinds of new innovations, whether it was the refrigerator or the elevator, but things that had massive impact on society. I think that's the better analogy. So I think we got to go back to the mid-1800s, study sort of what was happening then around electricity and then how that really changed the entire global infrastructure. That's going to be a much better way to study this and to think about this from an investment perspective.
So Erik, if you're right, and AI does represent this truly, historic, structural, decades-long paradigm shift, how do you think through, Erik, where the smart opportunities are for investors?
Well, I think if we go back to the electricity analogy, you had tremendous opportunities for investing because things that couldn't exist without electricity all of a sudden then could. I think this will be similar. So I think you're going to see new places for investment opportunity. I think this is also an opportunity and a time to get behind good management teams. I think in this kind of a world where change is occurring rapidly and the skill set is really, can you see around corners? Can you look into the future? That's a management team thing. That's not a question of whether you're buying a business for half a turn less or half a turn more. That's do you have the right management team with the vision and the ability to pivot and adjust in a rapidly changing environment? That's what the private markets look for, and so I think this will be a lot of good opportunity coming.
When you say good management team, Erik, that's interesting. Just dig into that a little bit more. What do you mean by good? What distinguishes good from bad leadership? What do you look for as an investor? What characteristics, variables, metrics?
I think you look for good changes depending on what kind of economic environment you're in. Sometimes good is the person that can manage costs in a rising rate environment. I think when we're talking about what the next 5 years are going to look like with the rapid development of AI and how that's going to seep into all facets of society, I think good management in that case is one that is able to look forward and to anticipate what change is going to happen. I think bad management is going to be those that are going to be very reluctant to move, wanting to kind of wait and see how others are doing it, and you're not going to have the luxury to wait. Change is coming very, very rapidly, and good management is going to be ones that can ride that wave and do it successfully.
One question you raise here, Erik, which I think is interesting, you ask, what if large language models aren't as scalable as advertised? That's a good question. What would happen, Erik? I mean, think through that. Who would be most exposed?
Well, in that case, you're going to see a huge negative impact to the public market, because the public market, to me right now, is completely tied to two key aspects of AI today, which is the large language models and the chip producers. That is all geared around sort of the same general theme. In the private markets, AI diversification is much wider because you're sort of seeing AI agents and AI-powered startups which are getting funded by private venture capital businesses, so much more diversity there. But if the LLMs are not as advertised or not bringing, let's step back. What's the public market telling us with the LLM providers? They're telling us that this is going to develop in such a way that their revenue is going to be a juggernaut and that companies are going to be willing to pay for that service because they're going to be generating enormous cost saves on the other end. If that transition doesn't happen at the pace and the rate that the public market is expecting, we're going to see a huge pullback on those stocks.
Erik, we'll end here. You talk about a growing narrative about this private credit bubble. From your view, your perch, Erik, is that concern justified? What does the data actually suggest?
The data is not suggesting that there's any kind of a private credit problem. I think right now we're very quick as a market to kind of paint with an overly broad brush. So what you're seeing is that you've got some lenders out there that have been lending with less scrutiny or less sort of investment prowess than others. That's no different than in the public markets, where we've got some people who are building great stock portfolios and people who are underperforming the benchmarks by a wide margin. No one goes in and says, when we see an underperforming manager in the public markets, oh, all the public markets are in trouble. Here, you've got a couple of bad lenders with a couple of bad credit portfolios, and now we're sort of extrapolating that to say that there's a big private credit problem. The data is very clear. Bankruptcy rates are going down, equity coverage ratios are going up, there's more equity cushion around there, and I'm not seeing, as we sort of sit on our very sort of broad perch, I'm not seeing big credit problems developing. That's not to say that you don't have problems with certain individual managers or certain individual portfolios, but I would caution people to not extrapolate that into some kind of big industry issue when it might be much more episodic.
Erik, great to have you on the show. Thanks for your time.
Always happy to be here. Thank you.